Artificial intelligence has created one of the most competitive industries in the world. NVIDIA, AMD, Broadcom, Apple, and many others are racing to build faster and more powerful chips. Investors spend countless hours trying to predict which company will dominate the next generation of AI. But what if that's the wrong question? Because regardless of who designs the winning chip, someone still has to manufacture it. And manufacturing the world's most advanced semiconductors requires an entirely different set of technologies. This is where Applied Materials enters the story. The company isn't competing to build the best chip. It's helping the entire industry build better chips. If that's true, then Applied Materials may not need to pick the winner of the AI race. It simply needs the race to continue. But is that really how the business works? To answer that, we first need to understand what Applied Materials actually sells. Most investors think Applied Materials is an equipment manufacturer. That's true, but it doesn't explain why the company has remained one of the industry's long-term winners. Applied Materials isn't simply selling machines. It sells the technology that enables chipmakers to manufacture increasingly advanced semiconductors at commercial scale. As chip designs become more demanding, manufacturers need higher precision, tighter process control, and better production yields. Those capabilities don't come from the chip design itself. They come from the manufacturing technology behind it. That's why Applied Materials business is tied less to which company designs the best chip, and more to the industry's ability to keep producing better ones. For investors, that's an important distinction. It shifts the focus from competition between chip designers to the long-term evolution of semiconductor manufacturing. If Applied Materials enables manufacturing rather than designing chips, where exactly does it fit in the semiconductor production process? A semiconductor doesn't become valuable the moment it's designed. It becomes valuable when it can be manufactured reliably, at scale, and with consistent quality. That's where Applied Materials creates value. Its equipment is used across multiple critical stages of semiconductor production, helping customers deposit materials, modify wafer surfaces, improve process precision, and increase manufacturing yield. The company's role isn't limited to one technology or one customer. It supports many of the manufacturing processes that advanced chipmakers depend on every day. This gives Applied Materials a unique position. Instead of competing within one segment of the semiconductor industry, it enables the manufacturing capabilities of the industry itself. But if Applied Materials has held this position for decades, why is the opportunity becoming even bigger today? The semiconductor industry isn't just producing more chips. It's producing more difficult chips. Every new generation demands higher performance, lower power consumption, and greater reliability. Achieving those goals requires more sophisticated manufacturing than ever before. For companies like Applied Materials, that's an important shift. The opportunity is no longer driven only by the number of wafers being produced, but by the increasing complexity of manufacturing each wafer. As the production process becomes more demanding, chipmakers require more advanced equipment, tighter process control, and higher manufacturing precision. That trend expands the value of Applied Materials without requiring the company to design a single chip. So what's making semiconductor manufacturing so much more complex than it was a decade ago? For decades, semiconductor progress was measured by one simple metric: smaller transistors. Today, that's no longer enough. Modern AI chips demand far more than transistor scaling. They require new materials, more process steps, advanced packaging, and tighter manufacturing precision. In other words, innovation is no longer happening only inside the chip design. It's happening throughout the manufacturing process. For equipment suppliers, this changes the economics of the industry. As manufacturing becomes more sophisticated, the value of enabling technologies increases alongside it. That shift is one of the biggest reasons Applied Materials is playing a more important role today than it did a decade ago. But what exactly is making these manufacturing processes more demanding? Let's look at the technologies driving this change. The semiconductor industry is entering a new phase where performance improvements come from manufacturing innovation as much as chip design. Technologies such as advanced packaging, high-bandwidth memory, HBM, and next-generation transistor architectures all have one thing in common. They make manufacturing more demanding. More demanding manufacturing means more process steps, tighter tolerances, and greater dependence on advanced production equipment. For Applied Materials, that's the key investment insight. The company doesn't need every new technology to become a commercial success. It benefits from the industry's broader shift toward more complex manufacturing. As long as chipmakers continue pushing the limits of performance, the demand for sophisticated manufacturing equipment should continue to rise. If manufacturing complexity is creating a larger opportunity, the next question is whether Applied Materials has the competitive position to capture it. Building semiconductor equipment is difficult. Building equipment that consistently meets the performance standards of the world's leading chipmakers is an entirely different challenge. Before a new tool enters production, it must go through years of development, qualification, and process optimization. Once it's integrated into a high-volume manufacturing line, replacing it becomes both costly and risky. For customers, the priority isn't buying the cheapest equipment, it's protecting yield, reliability, and production efficiency. That's why competition in semiconductor equipment is driven less by price and more by proven technology and long-term customer relationships. If customers rarely replace proven equipment, how does Applied Materials turn that advantage into a business with recurring growth? Most investors think semiconductor equipment companies only make money when they sell new machines. In reality, that's only part of the business. Once a tool is installed, it requires regular maintenance, replacement parts, software upgrades, and process optimization throughout its operating life. As more equipment is deployed across customer fabs, Applied Materials expands not only its installed base but also its long-term service opportunity. This creates a business model that is more resilient than many investors assume. Revenue doesn't depend solely on new equipment orders. It also benefits from supporting thousands of tools already operating in semiconductor fabs worldwide. If recurring services improve business quality, how does that show up in Applied Materials' financial performance? A strong investment thesis should always be supported by financial results. For Applied Materials, the numbers tell a consistent story. The company has delivered long-term revenue growth while maintaining healthy profitability and generating substantial free cash flow. More importantly, it has remained consistently profitable across multiple semiconductor cycles. That financial resilience reflects more than strong execution. It suggests customers continue investing in Applied Materials technology, even as the industry experiences periods of expansion and slowdown. For investors, that's an important distinction. A quality business isn't measured by one strong year, but by its ability to create value across an entire cycle. Which financial metrics best demonstrate the strength of Applied Materials business? High margins are rarely the result of charging the highest price. In semiconductor manufacturing, they're usually the result of creating the highest value. For a chipmaker, a production tool isn't judged by how much it costs. It's judged by how much yield it protects and how consistently it performs in high-volume manufacturing. If a tool helps produce more functional chips from every wafer, the value it creates can far exceed its purchase price. That's why customers don't simply buy equipment, they buy manufacturing capability. Applied Materials has spent decades improving that capability. The company's pricing power comes not from selling expensive machines, but from helping customers manufacture advanced chips more efficiently, more reliably, and with higher yields. If technology leadership explains strong margins, what allows Applied Materials to sustain that advantage year after year? In semiconductor manufacturing, replacing a qualified production tool is never a simple purchasing decision. Every tool is deeply integrated into a customer's manufacturing process, where even small changes can affect yield, reliability, and production consistency. A lower purchase price means little if it increases the risk of lower yields or production delays. For leading chip makers, the cost of disrupting a proven manufacturing process can be far greater than the savings from buying cheaper equipment. That's why competition in this industry isn't won by offering the lowest price. It's won by delivering the confidence that customers can manufacture billions of chips with consistent quality. If customers are reluctant to switch, how does that translate into long-term shareholder value? Strong cash flow is usually the outcome of a strong business model, not the business model itself. Applied Materials invests heavily in research and development, but once its technologies are adopted by leading chip makers, they can support production for many years through services, upgrades, and process improvements. That allows the company to convert a significant portion of its earnings into cash. More importantly, strong cash flow gives management choices. It can invest in the next generation of manufacturing technology, strengthen its competitive position, and return capital to shareholders without compromising long-term growth. For investors, that's what makes cash flow so valuable. It provides both resilience and strategic flexibility. Generating cash is important. But how effectively has management used that cash over time? A great business can still become a poor investment if management allocates capital poorly. Applied Materials has generally followed a disciplined approach. The company continues investing in research and development to maintain its technology leadership, while also returning excess cash to shareholders through share repurchases and dividends. That balance matters. Investing too little risks losing technological leadership. Returning too much cash could weaken future competitiveness. Applied Materials has largely avoided both extremes, using its cash flow to strengthen the business while rewarding long-term shareholders. For investors, disciplined capital allocation reinforces the investment thesis beyond the company's operating performance. Even the highest quality business faces risks. The next question is whether any of those risks could challenge Applied Materials' long-term outlook. Every investment thesis deserves to be challenged. For Applied Materials, the biggest risk isn't a single weak quarter. It's a structural change that reduces the industry's need for advanced manufacturing equipment. That could happen if semiconductor capital spending remains weak for an extended period, if technology transitions slow meaningfully, or if geopolitical restrictions reshape where leading-edge chips are manufactured. Competition also matters, but only if rivals can deliver comparable manufacturing performance and earn customer trust over time. These risks deserve close attention because they affect the long-term drivers behind the business, not just next quarter's earnings. If those risks are manageable, the final question is whether today's valuation already reflects the quality of the business. Valuation isn't about predicting the future. It's about determining whether today's price provides enough protection against uncertainty. My valuation doesn't rely on analyst forecasts or trailing 12-month earnings. Instead, it's anchored to the company's latest full-year earnings, representing a complete year of proven operating performance, and the valuation multiples investors have historically assigned to this business across different market cycles. This approach focuses on demonstrated earning power rather than short-term market expectations. That's why I present three valuation scenarios: conservative, historical, and optimistic. They are not price targets. They represent a reasonable range of intrinsic values based on what the business has already proven it can deliver. For me, valuation isn't about buying the cheapest stock. It's about buying a high-quality business only when the price offers a sufficient margin of safety. Applied Materials demonstrates that some of the most valuable companies aren't always the ones designing the final chip, but the ones enabling the entire semiconductor industry to innovate. Its long-term competitive advantage is built on technology leadership, deep customer integration, and the increasing complexity of semiconductor manufacturing. Those strengths have translated into resilient earnings, strong cash generation, and consistent value creation over many years. But even the highest quality business doesn't automatically become a great investment. Valuation remains the discipline that separates a great company from a great investment opportunity. Successful investing isn't about predicting the market. It's about understanding great businesses, valuing them rationally, and waiting patiently for the right opportunity. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.